Hi, let's discuss today the role of psychology in trading. The biggest mistake a beginner makes when first learning to trade is to assume that developing technical or fundamental skills alone will allow them to become successful. In fact, learning to control emotions is the most important skill that allows a trader to become successful because emotions have the biggest impact on your results. In this video, we will understand the psychological factors that affect trading. Successful trading does not depend on any single trade but a number of trades using a strategy. This means that a trader should be disciplined enough to stick to their strategy even throughout a losing streak. However, human beings do not behave in a logical way, and there are many a times when emotions influence us and we behave differently than normal. Do you remember the last time that you were angry? Maybe you did something and then were later surprised by your actions. As much as you regretted it afterwards, at that time probably you couldn't even help it. You might act the same way if you get angry in the future. This is because psychology of a person is made up of thoughts and feelings which incite him to act. And so, psychology shapes our behavior in every aspect of our life. Trading is no exception. A trader has to make several swift and complex trading decisions day in, day out. In order to achieve this with a certain amount of accuracy, traders need good mental balance. A lot of times, emotions get in the way of a trader, making him deviate from his trading plans, which include predetermined targets and stop losses. At times, traders end up incurring huge losses because they are unable to manage their emotions during a trade. The emotions in trading that have a negative impact on results are greed and fear. These emotions cause a trader to deviate away from his plans and can lead to further issues like ego and revenge trading. Any trader trading in the financial markets constantly faces a number of emotions wherein greed, fear, regret, and wishful thinking are the four most prominent ones. Fear of losing can lead to further losses. When a trader has a fear of losing, they try to avoid them. This can actually increase their losses. For example, a trader may open their trade and place a stop loss at 20 pips or price interest points away. In other words, there is a technical or fundamental reason for it being placed where it is. However, a trader that is influenced by fear may prematurely close it because it temporarily goes against them. So, if a trade goes against them by say 10 pips, then the trade results in a 10 pip loss. Now, if the trade turns out to be a winner, then the trader has just turned a winning trade into a losing trade just out of fear. Another scenario is when a trader closes his trade as soon as it goes into profit in a fear that he will lose that profit. If then the trade goes on to hit the profit target, then the trader has turned a full winning trade to a much smaller win. Let's talk about greed now. Greed results in trying to take too much profit but end up with less. When a trader experiences greed, they try to go for too much profit and deviate from their strategy. For example, a trader may place their profit target according to their strategy. This means that, as with stop loss, this also has a technical and a fundamental reason to do so. However, when greed influences a trader, they do not close their trade as their strategy dictates to and try to go for more. What can happen is that the trade can go against them, ultimately ending up with a less profit or worse, a losing trade. This means that they actually reduce the profitability of a strategy while trying to get more profits out of greed. Let's talk about regret. Regret is an emotion that comes both ways. That means a trader can regret placing a trade or regret not making one. Regret may make a trader to get into a trade after initially missing out on it because the stock moved too fast. This leads to a violation of trading principles and can make a trader incur huge losses. All you need to know is that it is okay to miss a few opportunities or to even make a few bad trades. No one can grab all the opportunities that the market offers. Once you've achieved this mindset, your trading perspective will change. Now let's talk about wishful thinking. When a position is not going in the right direction, we hope that the market will eventually prove us right. In some cases, traders just can't accept the fact that they made a mistake in their initial analysis and increase their exposure, making a dangerous average price trade. Then you have wishful thinking mixed with the will to recover losses, which will make traders trade too much or too often, or to increase the size of open positions. This behavior usually leads to further negative results caused by risk taking beyond what the trader can actually handle. To avoid emotionally influenced trading, you need to have a discipline that will allow you to think as objectively as possible. There are several ways in which you can do this. Trade with a tried and tested strategy. You are much more likely to remain calm under pressure if you have confidence in your trading plan. If a strategy has not been tested enough, it may lead to doubts that could allow fear to overwhelm you. Demo account trading. Testing and further development of a strategy should be done on a demo account first before using real money. Using real money creates an additional pressure which will amplify the negative emotions involved while trading, which can lead to further losses. Accepting the risk. A strategy with a 100% winning ratio is unrealistic. You must be prepared to take the losses. It is normal to hope that every trade will be a favorable one. However, inexperienced traders are likely to experience a higher emotional impact when they take a loss. In contrast, a profitable trader is able to accept losses as part of their trading strategy and move on to the next trade without allowing fear or greed to affect their future decisions. Let's recap. In this video, so far we have learned that 1. New traders make the mistake that skills in technical and fundamental analysis are the most important element in trading. 2. Controlling emotions is actually the most important skill that a trader should actually focus on. Fear of losing can cause a trader to close his trades early before the trade has run its due course, leading to further losses. 4. Greed can cause a trader to let the trade in and not close at a specified target as the strategy tells him to. This can run the risk of taking lesser profits if the market turns against him. 5. Having confidence in your trading plan and trading with a demo account ultimately helps in learning to control your emotions. 6. A strategy with a 100% win rate is unrealistic. You must learn to accept the risk on each trade. Learn to deal with your emotions and make huge wins in the market.